All right, folks, welcome to the Marketing Analytics and Insights live show. Katie is off this week, so we're going to behave irresponsibly. No. John, what are we doing this week?
Today we are talking about extending on last week. We were talking about trends, what's going on. So we've got the mathematics behind trend detection. You've got some methods to measure, and then also how to know when to act, when to actually put this data to use. So hopefully we're going to deliver the formulas and the so what that Katie has demanded in lack of her presence. So here we go.
Fair enough. All right, so let's start with this because I think it's important. What is a trend? To you, what is a trend?
Yeah, I don't know. People talk about the Zeitgeist. I love that term because it's inside baseball, but it's just every once in a while, certain topics gain some heat and some traction. And a lot of them can be black swans where you just, something explodes out of nowhere, some random meme. But then there's other trends that are cyclical or have, repeat over time or when certain things happen. And that's the kind of stuff that you want to jump on because there's many times where, if you live and die by corporate goals or hitting certain targets, if you can find trends that drive that stuff, you can make things completely predictable. And that's where you'd really love to be.
Yeah. Let's look at a few different terms because I think we should probably clarify some of this. I'm going to go ahead and flip over to our art easel. Got the whiteboard going today. Let's do some basic art here. If you were to look in your analytics and see something that looked like this, what would you call that?
First it would be a spike. I'd call that. So
Yep.
that would be that's my economics term would call that a spike.
Exactly. Mathematically or statistically, we call that an anomaly. Something weird happened here, right? And then we go right back to where we were, right? So we start here, and then if you actually would just pretend this didn't exist here, essentially you would be kind of just the same thing, right? You start and ended the same place. So that's our first thing. Anomalies. We always have anomalies, and it can be anything like a bot attacking your website. It could have been a popular post on Reddit that sent 1,000 visitors to your landing page. It could be any number of things. It could be an ad that ran really well. So that's our first part, is the anomaly. Next, what would we call this?
Oh, that's upward trend. Yeah, that's one of the two holy grail.
Exactly. So that's the upward trend. So a trend is essentially, in this case, either an upwards or a downwards decline, advance or decline in the data. So we have this. Imagine the mathematics here. We have this sort of average here, and then we start to deviate from that average more and more and more. And a trend can be, it doesn't necessarily need to stick like that. So let's draw this. Here's our trend and back. So this section here would be a trend, right? Where something has happened, we've got a big difference. If we have that average line, there's kind of a big difference for a while, and then we start headed back towards the average line. So that's a trend. And that's something that importantly is mathematically important. And then there's a third category, and this is I think is the holy grail, which looks like this. What would you call that?
That a new plateau is, usually how we describe that. You're jumping up to the next level.
Exactly. So in mathematical terms, this is a breakout, right? So it trended for a while and then it stuck, right? So hopefully this is your website traffic. Like, this is the hope of every marketer, is you run a big campaign, you get this big boost, you're happy, and then the audience sticks around. They find so much value in you, they continue to give you the thumbs up. So that's what we want to talk about today. Today we're talking about trends, but the goal of our marketing, the so what, is to find trends that lead to a breakout. To find trends that lead to a sustained level of growth, because it's not much fun if after your campaign is done, you go back to the beginning, right? That's no fun. What we want to do is we want to figure out how can we see things that will eventually lead to breakouts. And the bad news there is there really is no easy way to know that, right? It's one of those things that only happens in retrospective. You can't tell in advance that this is going to be the thing. There are very, very few companies that have ever done that. The only one I can think of off the top of my head that's had 3 breakouts is Apple, right? First with the personal computer, then with the graphical interface, the Macintosh, and then with the smartphone. So like the 3, I guess 4, because they had the iPod, the portable musical player. Not many companies. Most companies are lucky if they get 1 breakout, much less 4. So it really is something special. So how do we determine this? How do we know that what define these things? Well, let's pull up our good old friend Microsoft Excel or the spreadsheet software of your choice. You don't have to use Excel. I just know that most people do. The first thing you need for any kind of trend detection is the data itself. So I pulled some data here from Google Trends, which is, if you have not used Google Trends, I don't know what you've been doing for the last few years, but it's one of the best public data sources for just general trend things. So let's pick on, have a little bit of fun here. Let's pick on the NFT, the non-fungible token. Just from eyeballing it, you don't even have to use any math yet. What would you classify this as so far, John?
You better have already short sold, because those tokens are getting to be worth less every day, it looks like.
Well, so these are searches. These are not actual dollar values. And again, this is data can be applied to just about anything. But we want to get data that it has two things. It has a numerical value, which Google Trends provides you, and it has a date. Those are the two most critical pieces that, for trend analysis. If you don't have those two things, you really can't do trend analysis. At least you can't do it in any sensible way. Now, as we were just showing, the first thing you want to do is just do a bit of exploration. So I'm going to put in a chart here. Oops, get rid of that. So let's do, I'm going to use Clubhouse too. Everyone's, well, I don't know how to describe
favorite punching bag would be the
exactly favorite punching bag. And obviously Clubhouse is a search term that has existed long before the app that we know. But we can see right away that there was this background noise and then big spikes, coming in here last year and then this year for NFTs. So our first step, always take a look at the data. Just see if there's even a there. If there's not even a there, if it's just a flat line or something, then you probably don't need to do a whole lot of extra exploration. In this case, it looks like there's something that's happening. So our next step, trends, remember we said are increasing or decreasing. So the thing we want to look at is what is the rate of change? So let's do, which one do you want to do more, John? NFTs or Clubhouse?
Oh, let's look at the NFTs. That's definitely more fun.
All right. So we're going to do column called change here. And I'm going to do good old fashioned new minus old divided by old. That's our rate of change. And populate that down. And we have divide by zeros. That's fine. It's not fine, but it's fine in this case. Ignoring those divide by zeros for the longest time here. In fact, I'm going to do this for anything that is a zero, just to avoid. Let's do an advanced replace. If it's 0, I want to replace it with 0.001, just so that we have something there. Okay. Close. And now we have our graph. That's not really all that helpful, is it? Yeah, let's undo that. Okay. So for the longest time, there was no search volume for NFTs, right? Just wasn't. And then you start to see that rate of change really start to crop up. Like, okay, there's something happening there. And then you get to this, some pretty big changes, like 2.5x changes, and then going back down. So we can already see that there is something there. I'm going to, we didn't even have anything till row 230. So I'm going to go ahead and just drag this down there, just to make the graph a little bit cleaner. And now our rate of change becomes 0. Now, the challenge with this is because we were talking about, is something increasing or decreasing? Anytime you're working with day level data, it does get kind of messy. It gets very noisy because you have fluctuations happening all the time. So let's make a 7-day average here. And I'm just going to roll the 7-day average of our change. Go ahead and take away our initial chart and put our 7-day average chart up instead. And there we see our rate of change. Generally speaking, when when we're talking about, like, should you pay attention to a trend, once it starts that ascent, yeah, you probably want to be paying attention to it. You're going here to 14% change date, for rolling average of 28% change, and so on and so forth. So you start to see this increase until it really explodes, until you get, you're well over 100% change here, and then you take the roller coaster ride all the way back down. So you almost have two trends here at the same time. If you split it down the middle. So that's one of the easiest way to detect a trend, is just do a moving average and see, is there substantial increases, or is it flatlining? Because if you were to take this exact same data, and actually let's do this with Clubhouse, because Clubhouse is a good example of this. And I'm just going to do have new minus old. By old, and do this. And I'm only going to do a few days worth here, because we know that Clubhouse didn't actually exist as a search, an important thing at least for marketers for a while. I'm going to plot this out here, our 7-day average. Now let's go ahead and insert our plot. And what we see is kind of that up and down volatility, kind of bouncing up and down, but it's hovering around that zero line. It keeps coming back to zero eventually. That's an example of something where there isn't a trend, right? Where you got this up and down noise. There's no trend. There's nothing detectable saying like, yeah, there's big changes from day to day. There really isn't. It's just, some relatively minor noise. Now, if we take that and extend this all the way down, now up and down, up and down, up and down noise until you get into a little bit later on. Then you start getting, okay, now we're starting to see some real stickiness to that increase. So it doesn't stay back to anywhere near zero for a while. When you've got your trend that kind of averages out to zero, hovering around that zero line, and then suddenly it pulls away from that and stays pulling away from that for a little while. Now you've got a trend. Now you've got something like, okay, there's a trend there. So imagine doing this with, say, like your open rates for your email newsletters, for your Twitter posts, for views on your YouTube videos. What you're looking for is for it to start pulling away from the zero line on a regular basis. Like here, you can see these are fairly close to zero, and then you start saying, okay, now we're above 5% pulling away. Now we're above 10, 15, 20, 25% just pulling away and staying pulled away. That's a trend. So from a mathematical perspective, that's a relatively easy way to figure out these trends. So here's the next challenge. When would you take action, John? When would you say, I got some money, I'm ready to invest in, an NFT of, I don't know, Bugs Bunny with a helicopter on his head. I don't know. When would you make that decision?
Yeah, that's, unfortunately, hindsight will always give you better, results. I mean, anybody here would be like, okay, let's see that. You've kind of got that first surge. If you had your choice, you'd get at the lowest point before that first surge, right? I mean, that would be where you could make the most profit. But of course, at that point, you'd be sitting there saying, oh my God, it's flying through the floor here. We're not going to do that. Now, you do have kind of a whipsaw there, which is interesting. It went up and then went back down again. And so that, it's a question of like, how brave are you? Or when do you want to jump in? A lot of formulas I see will do, you take a second larger moving average. And when it gets above a certain point over the moving average, you say, okay, that's when we're going to jump in and dive. Because I think you would definitely want to, when that second peak went above the first peak or was up near that first peak, that's, when your moving averages should be yelling at you to buy in.
Exactly. So what you're describing was called a moving average convergence divergence indicator. And all it really is a shorter term average differenced by a longer term average. So I'm going to put together a 30-day moving average here. And let's go down to cell 31, 32 equals average. We're going to do our rate of change. And now if we plot these two things together, let's make this nice and big so that everyone can see it. The orange line is the longer term moving average. The blue line is the shorter term moving average. And what you were saying is exactly right. You're looking for when the blue line pulls away from the orange line and stays pulling away from it. Like, because there's lots of points in here where there's not much of a difference between the two, and it's bouncing back and forth. And then this is the first point where there's a lot of area under that blue line that wasn't there previously. And then even more so to the point where the orange line pulls up. So the buy point for you really would have been probably about here, right? Where you see that big change in the orange line. The orange line is starting to pull up, and then the blue line pulls away from it again. So that's the divergence where you see the short-term average, things are popping, there's interest in this thing. That's when you buy in, so you catch all this upside. And then the big question, of course, is when do you sell? You probably would have, ideally like to this be the point where you don't lose anymore. So if you buy in here and you sell here, you've still made a decent delta, right? Now, this is a 7 and 30-day moving average. You can change those two windows to be whatever is appropriate for the trend you're trying to analyze. Is it, email open rates? Well, you might have to have like a 90-day average. If you send emails, only once a week, a 90-day average is probably going to be about right. If your sales cycle is 2 years, you're going to need a lot of data, and your moving average might be like a 5-year moving average if your sales cycle is that cripplingly long. But moving average, convergence, divergence indicator is exactly the way to go, because you look at the variances, you look at the differences and say, okay, hey, something's pulling away here. Now, yeah, obviously, if this has been something you've been keeping an eye on for a while, this would have been the point to buy in, and then sell off right around here when you first start to know some big percentage change differences. Okay, like let's sell off maybe here. But even if you were to follow what we've outlined so far, you still would have done pretty well.
Yeah, you could have taken advantage of it. The other thing with that is you do have to layer on just intelligence, like whatever like if you realize that, hey, a new product dropped here at this point, that's something that could drive your decision-making factor the next time the cycle comes around. Or it's, hey, we lost a CEO, or whatever, any kind of black swan events can help that. But those moving averages are just trends. It's just you're picking up more population, and so that's the easy stuff to spot.
Exactly. So let's look at another data series, one that is a lot more mundane and a lot less buzzy than NFTs and Clubhouse. Let's look at TSA passengers, people who walked through a TSA checkpoint. We're going to do the exact same thing. So we're going to put in our rate of change here first. So, and if you want to get this data, go over to tsa.gov. You can get this data from the Transportation Security Administration. So new minus old divided by old. And what we're looking for is passenger changes through TSA checkpoints. Let's do our 7-day average. Go down to here, make a nice 7-day moving average for percentage change in passengers. Now let's do our 30-day average. Cell 32. And now let's go ahead and plot our things, because what you were just talking about is so important. This is, we'll play the game called Spot the Pandemic, right? What you're seeing here is that the blue line is the 7-day moving average of number of passengers through the checkpoint. We see that took a nosedive last year, and then you have the 30-day average following it, following up behind it, and then both of them coming back to a little bit towards equilibrium. But what's interesting here is before the pandemic, you can see we're kind of hovering around the zero line. It was there was growth, but it wasn't huge. And then after this, when we started the recovery period, you're seeing that there's a lot more space under both lines than there was prior to. Now, those big spikes downward, those are holidays, right? Those are Christmas and Thanksgiving. So, where people traveled a lot the days before and then didn't travel on those days again. So, again, it's a good reason to do that. It's kind of smoothing. But we're at a point now where, as we start returning to baseline, where this here at the end looks very much like this here at the beginning, we can say with some level of confidence, hey, it looks like things might be getting back to normal. And if you were to chart out the actual passenger throughput itself, let's put this up so it's visible here. We do indeed see, we've got that trend. It's a very clear trend that's happening here. And right here at this endpoint, you can see we're kind of even with, the sort of the bottom end of the pre-pandemic days. So we really are at a point where our moving average convergence divergence indicator is saying things may be closer to normal than we think if we got passengers coming through. So now the question is, what do you do with that? Well, obviously, if you were selling vacation packages, you probably should have started your marketing here, right? And you definitely should have your marketing, going here. So this would have been about a month ago that we're starting that ramp. But you can definitely see just what the basic trend line here is. You need it to get going. There's some software out there that can do a lot of this trend analysis for you and save you don't have to do it in Excel. One of my favorites for doing that is a piece of software called Tableau. Tableau software is actually it's now owned by Salesforce, right?
Yeah, part of their. Well, I don't know if it's part of their Digital 360, but yeah, it is definitely one of their clouds.
So you could take this exact same data and try to put what are called trend lines onto these charts. Now, trend lines can be a little bit tricky. Most of the time, you want to be using, you want to look at the data and then try and find a reasonably close fit. So let's go ahead and pull up this here. There's our same TSA data. And I'm going to change the trend lines to what comes out of the box. So out of the box, it comes with a linear model, right? This is not super helpful, right? That line being drawn, down to the right, doesn't really tell a good story of what's actually happening. So we want to find what are called polynomial lines or curved lines, and try and fit a line to it as reasonably as possible without going completely off the rails. So really, about that third or fourth order polynomial, you can see fits the curve pretty well. And we can see here at that point where the curve line changes inflection, right? Again, if this is a point where you're buying, you're like, yeah, I might want to start buying in here, start doing something here. By the time you get to here where it's going up and up and up, like, yeah, you really have to have been, doing something, getting ahead of your marketing.
Yeah, that's just like classic contrarian investing. It's like when things are really bad, that's the time to go out and buy, because you could ride that whole way up. If you wait for that curve to turn, you're losing about almost 5 whole months worth of upswing there.
Exactly. A more practical example for a lot of retailers, if you were to put in gift guide here, this is pretty straightforward. This is from last year. This point here, that inflection point in the trend, is where you probably should have been doing something, right? So at this point here, October 25th of 2020, if you wanted to make the holiday season merry for your marketing, that would have been the point to get into your marketing into markets, so that you take advantage of people searching for gift guides here. If you work in public relations, for example, and you know that it takes 3 months for a magazine to accept a pitch. Well, if it's October, then you had better be pitching for the October issue back here in June, right? So from a PR perspective, if you're not pitching gift guide stuff now for 2021, the boat's leaving.
You're not going to be in the magazine.
Exactly. The boat's leaving the dock right now today. You need to be on it if you want to hit this exact same curve for 2021. And this is, again, one of those things where if I zoom out to 5 years, there is a obvious and distinct
pulse.
Exactly. It's a pulse. It's a retail pulse, right? So if you know when that's going to be happening, you know how to get in front of it. One that's a lot more challenging because it moves is Prime Day, right? You can see here, it used to be semi-regular. Then last year was a huge delay, and now it's coming back. I think it's coming back, in a couple of weeks, right?
Yeah, I think July at some point. So they're trying to get back to that half Christmas date.
Exactly. So in the past, Prime Day sort of peaked on July 14th, and it was a month beforehand that it had done really well. So each of these times, Prime Day here was in October 11th, and September 26th was where that inflection point. So again, if you know from past experience, if you've got seasonality to a trend, you know when to get ahead of it. You've got, in this case, Prime Day, it needs about a month worth of advance time if you want to hit it. And like one of the things Katie always says, if you are not don't have plans written out and scenarios written out, this would be the time to do it, so that if Amazon says, hey, it's Prime Day in a month, you're like, okay, pull out the Prime Day emergency binder and execute all the marketing in it.
Yeah, I'm amazed there. It looks like they really did bite them hard that they went that late with it. I mean, they lost 2 whole years of momentum over that, which is insane given how much e-commerce exploded during the same period.
Exactly. Yeah, you would think in a year when everyone's sitting at home,
Yeah.
it would have done well. But it's like the old joke we always say: when was Seinfeld on? What day and time? And people still remember Thursdays at 9
Thursday
on
nights,
NBC.
must-see TV. Yeah.
And why do we know this 25 years later? Because it was regular, predictable, and valuable. And when we're dealing with trends, if you have something that's regular and predictable and valuable, and then you break the predictable, you're in trouble.
You lose the momentum.
Exactly. So we're going to leave you with this thought. Do this kind of analysis in your web analytics. Do it for traffic on your website. And the reason you want to do that is that you want to know what are sort of the extremes, like how much does something change when you have an anomaly, when you have a breakout, when you have a trend happening. What extreme is that? So if we were to look here, let's go ahead and just go into basics of acquisition here. So I'm using Google Analytics 4, and we want to do this in Google Analytics 4. For us, our big swings tend to be about a 200% difference day to day. If one day and you're seeing a lot more traffic coming the next day, we want that anomaly and trend detection knowledge. What is the biggest percentage change? Because what we're going to do is go into, let's go back to home here. In your Google Analytics 4 account, and you can do some 3, but the software does a much better job of it in 4. Go to Insights. We're going to go to View All Insights. And now we're going to create a new automated insight. And you can see there's already some anomaly detection built in here, but these are Google's settings. So I want to create a new one and evaluate it daily. I'm going to do users, total users. And I want it to be a percentage increase more than 200%, right? Since the previous day. And this is our own anomaly and trend detection.
This is the call your lawyer because things are looking bad or good.
Exactly. Well, so this is a percentage increase of more than 200%. So I want to know, it's fine if Google tells me like, hey, we think there's an anomaly, but I know from our own data as in background, I want to know that specific thing. Tell me when that happens, because it's important. We also do have another version called Who Broke This, and Who Broke It is when you have a 90% decrease from the previous day, it's like the tracking code went missing. This is the so what of trend analysis, when you have the ability to look at trends, digest the data, and then you set up alerts to say, like, I want to know when we see some big spikes so that we can so we're not looking back in a week going, hey, we got a lot of traffic last week. Pity we didn't do anything with it.
Staying in front of it, isn't it? That's it. And if you can be there as it's happening, you can actually even stoke the fire if it's something that you could get involved with. It, you throw a discount on the pile or whatever. Exactly.
One of the things you can do is you could set for hourly. Now this is really getting really, really tricky. If you want to do that hourly increase, like a 500% increase hourly compared to the previous hour, that would tell you, like, hey, something's really hitting us hard. The catch is you should do the math first, because if your site has 1 visitor at 6 a.m. and 10 at 7 a.m., you're going to get swamped with alerts.
You're going to get tripped with that all the time. Yeah, exactly.
Exactly. But yeah, you can take action on these trends. And that is the so what, is when you detect a trend or even an anomaly that you think might become a trend, have your software tell you, hey, I'm raising my hand here. You might want to take a look at this. You might want to see what's going on. Is a bot hitting your site? That would be a good thing to know. Are customers hitting your site? I don't necessarily know how to use traffic, but certainly like conversions. Like if you're an e-commerce company and you don't have like a 5x detector in your sales, like turn it on like today.
Yeah.
Because you should know, hey, we made 5x more sales in the this hour than we did the previous hour, or whatever the biggest jump is that you have in the past. That will tell you, yeah, we need to wake up and pay attention to what's going on the website.
Do more of that. Yeah.
So that is determining what's trends. We talked about the mathematics, the change, 7-day changes of changes, the moving average, convergence, divergence indicator, and how to take action on it. Either for things that have high seasonality and cyclicality, measure the inflection points of trends in the past and figure out what is your lead time that you need to get in front of a trend. For things that you know are going to happen, and for things that you don't know what are going to happen, have built into systems like Google Analytics 4. Hey, I'm raising my hand. Something's happening. Please do something about this. Any parting thoughts on trend management, John?
No, again, it's the same as every week. You go grab some data and go dig in and find it, because unless you have these alerts set up, you're again going to be doing that 2 weeks later, looking at the numbers, saying, "Geez, I wonder what happened right there." And you're not in the driver's seat if that's the case.
Exactly. All right, folks, if you've got questions and stuff, head on over to the Slack group and ask. Otherwise, we will see you all next week. And I just roll our... Thanks for watching today. Be sure to subscribe to our show wherever you're watching it. For more resources and to learn more, check out the Trust Insights podcast at trustinsights.ai/TI podcast and a weekly email newsletter at trustinsights.ai/newsletter. Got questions about what you saw in today's episode? Join our free Analytics for Marketers Slack group at trustinsights.ai/analytics for marketers. See you next time.